Hello, hello. Good morning, good afternoon. How is everyone doing? Made a mistake and bought warrants. I'm not sure which warrant are you referring to, though. Good afternoon. Happy Father's Day to all that. Oh, is it today? Didn't realize it. All right. Yeah, I guess. Then it is today. Happy Father's Day to you as well. I guess there might be some plans, probably secret from me. So I'll discover maybe sometime later. We'll see. I didn't realize it is today. Oh, tomorrow. Okay. All right, what else? Samsung made a mistake and bought. So I don't know which warrants are you talking about. WeWork. Oh. WeWork is not working. That's all I can say for now. They've been trying to resuscitate the company, but it's been a very difficult position. So yeah, I'm not touching WeWork right now. I don't know. Last I knew it was like below $1. Actually, my company, we have we are 100% remote. So and if you have to meet as a group, we basically have a pass for WeWork, and we go to the WeWork and then we meet. I still can't figure out how they are able to manage the economics. Looks like they are not able to. So that time I looked at WeWork. What is it now? It's now 24 cents. Jeez. I think, yeah, it's been a brutal run for all the WeWork investors, but I'm much happier that these shares were not pushed out to retail investors at $40 billion, right? That was the valuation at which it was trying to come IPO, from 40 billion to 463 million, almost 100 times. Is my math right? Probably 100 times less than what they were trying to push the shares onto the retail investors. On 3.3 billion sales, 180 is almost $1 billion of loss. So yeah, it's in pretty bad shape right now. I don't know who's going to rescue them. I don't know if SoftBank still has an appetite. Probably they may. Who knows? With some of the market heating up, some of the shares of that SoftBank own have done pretty good in last 6 months. So, but yeah, for me, WeWork ain't working. As an investor, it is not working. So the economics are just so bad. So there are different type of warrants. I don't know which WeWork warrants you're referring to, but there are some warrants which allows customers to buy the warrants now and convert them into the shares later. Right? We have seen these whole warrants coming out during the SPAC mania. Many of the SPACs that came out also had issued warrants, right? So you could buy the warrants, and in some cases, the pre-merger, if I buy a share, then post-merger you will be entitled to a certain number of merged company plus warrants and all that. But right in recent times, I have not seen much retail involvement into warrants. Big money managers or institutional funds, they do get into this, warrants, and it's like a kind of a call options, if you may, right? It'll give you right to buy the shares. But I saw some involvement from retail investors during the SPAC mania in 2021, not in recent times. So I don't know. I mean, what did you, maybe they came out with warrants. Yeah. Okay, yeah. So you mentioned these are the derivatives, give the right, not obligations. Yeah, this is like similar to call option. Right. So Hong Kong crypto. Hong Kong has been pretty, it's been in the news in terms of a crypto because they came out with their more, I mean, they came out with the regulations. I don't know if those were like friendly regulations or are those unfriendly to the industry, but at least Hong Kong came up with some regulations which will also allow, I think, investors to trade in crypto, which was seen positive, especially in the light of what's happening in US. I think any regulation is a positive regulation. Oh, by the way, there was some big news on crypto. The world's largest money manager filed for listing and a Bitcoin ETF, Bitcoin trust, but it will function more like an ETF. Right. So there is a lot of chatter around that. Did anyone follow on that one? I know not too many crypto fans, but so I'll probably just give a headline and then we will see if there is more interest to talk about it. BlackRock, the largest money manager in the world. It manages around $10 trillion asset under management. BlackRock filed for a Bitcoin trust. But it functions more like ETF. So BlackRock, Bitcoin, ETF. There was a lot of confusion around, is it a trust? Is it going to be like GBTC or is it going to be a spot ETF? And then I was listening to some Bloomberg experts. Those were ETF experts to understand what the structure is. Is it going to be like GBTC? Because the filing says Bitcoin trust, right? I've not gone through the filing. I don't think I'll have a time to do the filing. So why not use the work done by others, right? So I was listening through some of those experts in terms of what the structure is. So this structure is going to be just like GLD. So GLD, though it's owned by trust, but it just trades like an ETF. It is going to be the similar structure. And there's a lot of chatter around why would BlackRock do it if they know how, everything about ETF that is there to know and what SEC will approve or not approve it, right? Their track record is so far BlackRock has filed 576 applications for ETF and 575 applications have been approved. So their track record has been pretty spotless, I would say. And then there was chatter, why is BlackRock getting into filing Bitcoin ETF, right? Where we know that SEC has been pretty much dead against approving any ETFs. There have been Bitcoin ETFs being filed since 2013, and none of them have been approved. But maybe BlackRock knows something. Maybe they don't know how SEC would work, or the other thing could be a little more political angle around this is, hey, Larry Fink, who is a CEO of BlackRock, is a Democrat. Maybe if it gets rejected, they're trying to send a message saying, hey, this stuff doesn't work. Or the third angle, which a lot of maxis are discussing, is we told you, US government is out there to kill crypto native companies so that the bigger financial institutions can come and control this industry, right? Choke point 2.0 thing that we have discussed. So we'll see we obviously, I don't have any insight into what's the real motive is, but I'll be surprised if BlackRock will go all the way to file this if they don't have a very strong feeling about, guys, I think we can get it through SEC and have it approved. but yet to be seen. So we saw a merging between the traditional finance and the crypto side of the house as well. That was one big news. Other than that, I think the markets were pretty good. If you look at the June, S&P is up, what, 6% for this month? That is ridiculous. Overall, if you look at SPY is, come on, SPY is up 15.5%. Yep, nothing to complain if you have stayed invested in the market. Yeah, that's why we don't even know how these cycles will come and go. Last 8 months have been spectacular. Not sure about what the next 6 months going to do, but I ain't complaining. Pretty decent run, even if it is being supported by a few of the stocks, right? Few of Magnificent 7 or Big 18, whatever you may want to call. But this is how the index is, and this is, if you've just put in SPY, done your regular investment in 401k, pretty nice situation so far. What else? What else do we want to talk about? Today, I thought maybe I'll go back to a little bit basics, talk about option management strategies, right? Hey, I sold this. Now it is challenging me. What should we do? Want to talk about that. Also, there's a Charles Schwab had their wealth survey out. So want to look at that in terms of how Americans are feeling about wealth. So yeah, those are the two, I guess, big topic. Of course, we'll just talk about FOMC, what happened. A little bit confusing on what message is Fed giving, right? It was a mixed message. Ramesh says, stop selling Tesla and NVIDIA call options. Yeah, these things keep ripping higher. You think at some part of a time, some sense will prevail, but nope. So yeah, I had call spread on NVIDIA. So I don't have anything on Tesla, but one lesson which I learned 2021 is the craziness can stay. 2020 and 2021 was craziness can stay in market way longer than we might think. So I decided, no more. If I really want to hold this stock for long term in my portfolio, let's not just sell call, maybe convert it to a spread, because who knows, these we'll never expect, but the company which is like $600 billion, $700 billion could jump another 25% in a day, right? And at that point of a time, I don't want to be left out of those gains. Yeah, Tesla has been Tesla has been the darlings of, I would say, option trades. Every time I hear about which is the most traded individual tickers, not the index or ETFs, Tesla is always on the top. And it has surpassed Apple by long. But interesting to see the IV also going higher in Tesla as the price is going higher. How about NVIDIA? NVIDIA, almost same thing. We had a recent bump in IV. So that does tell us at least the risk or the velocity, not just the risk, but the velocity of the risk is on the upside. Means a lot of call options buying happening in this ticker. And people are becoming a little more complacent right now on these tickers. I think even on the overall market, SPY, at least I saw some different phenomena on Friday. Friday, the market went higher. And then I noticed that along with the market, the VIX was also higher. Generally, we don't see that. So I saw the VIX higher. Okay, maybe at the end, probably it came down. But when the market was ripping high, I also noticed that the VIX was also higher. I'm like, what the heck? Generally, it's the other way around. We see VIX spiking if the markets are going down, because that's where the velocity of the risk is. But things have changed. A lot of people are buying a lot of, there's a lot of a risk on the upside. So we see all this call buying going on. I think I do have a little bit of a material to talk about it, why this may be happening. Right? A lot of call buying is happening even in the individual tickers, as well as on the overall indices. Any update on ChatGPT use on TOS? I think beyond that, the initial one, only other thing that I added was all-time, or not ATH. Basically, it also tells me this label. What I added was to tell me of the period I selected, how much is it down, from that period. So way it helps me if I'm looking at, let's say, a stock, let's say pick up Shopify. I know Shopify has done pretty well this year. It's up 81% for the year, right? But I also want to know, okay, how much has been still down? I can go and see last 3 years if I want to see. It's still down 63% of its all-time high in last 3 years, which is, I guess, for Shopify, that is their all-time high. So I did add another label to tell me, yeah, great. YTD, it's up 81%, but that it's no longer near its all-time high. It is still 2/3 down from its all-time high. So I think that's the only change I added. And I asked ChatGPT to give me the study which will calculate this. It gives us some perspective, saying, hey, these stocks have been ripping higher. Meta has been ripping higher. It's up 125% for the year. But from an all-time high perspective, it's still down almost 25%. Yeah, so it still hasn't caught up to its all-time high. Whereas if I look at NVIDIA, right, NVIDIA is almost closer to where it closer to its all-time highs. So yeah, I added that one. So if I'm looking at some of those holdings, it gives me a perspective of, is it really at all-time high? Or is it, yeah, it has run up, but still maybe a lot more yet to catch up. Apple is not. Apple is trading at its all-time high already. So that's another thing. Problem with the spread is short-term capital gains. That is true. I think call it a problem. I would say it's a good problem to have if you have a gains. But when you're dealing in a short duration options, 60 days, 90 days, anything less than a year, yes, this will be there, getting a short-term capital gains if you have a gains. But I would say that's a nice problem to have. I think it is better, for me personally, it is better than trying to get a gains on the individual stock positions and sell the stock, because I'm scared of holding it, don't know what to do. If the stock goes high, I would rather sell calls, take a short-term gain on calls, and still hold the stocks for longer term. Well, that's a choice. That's a choice. But yes, short-term capital gains do impact when you're trying to dealing with the short-term options. Okay. Alrighty. So let's go through the regular ones. Today, I guess it's a long weekend in US. So I appreciate you folks joining in for the long weekend session. Could have done anything else, could have gone out. You got one extra day. But so I'm glad you guys are here. and we can talk about anything else. I mean, don't have to go to necessarily what the content that I have. I'm putting these two in coffee can portion. Yes. So I did a good thing that happened. I would say last month is I read about coffee can. Again, this is just a behavioral change, right? The most difficult thing in investing is changing our own behavior. And the coffee can portfolio gave me just a framework to change the behavior, right? Now I have a list of, okay, these are the stocks that I hold. I'm going to put this portion of a stock into a coffee can, and then I play with the rest by selling calls, right? So if let's say for me it is clear in terms of, hey, I don't want to be left out of let's say stock is ripping high, that's fine. I know what's in my coffee can, and the others is what I'm playing with. So that's so for me as a framework, that is helping me. So I went through my stock list and say, okay, which ones I want to put in coffee can and how much. If I own 300 shares, maybe I'll put 200 in coffee can. That gives me, okay, I can continue sell one covered call on this one, right? Or if I to sell two, then I know that I need to buy back a call on, not let my share called away, because hey, it's a part of my coffee can portfolio. I need to hold these shares for next 10 years. So just a framework. That framework helps me. I hope it helps you too. Our mind is tricky. We need to give these excuses to mind to just help us do what we want to do, right? So coffee can as a framework was a little bit helpful. All right, so let's look at what happened last week, and then we jump on to talk about options, adjustments, and anything else, right? So CPI numbers, almost near expected, month over month up 0.1%. I think everyone was focused on CPI year over year, which we had 4%, which is pretty good, right? Now, what we need target is 2%. That's what the Fed target is, 2%. Core CPI is 5.3%. We'll see. But one thing that occurred to me, if you go back and listen to what Jerome Powell used to say, was now at least now we have our Fed funds rate, which are higher than the CPI number, right? Which wasn't the case earlier. So I don't know why he said that we may still have to increase. We may see increases, couple of increases later in the year. But for this one, Fed skipped increasing any interest rates, right? So watching this Fed for the last few years, to me, it looks like they're just towing the line that market is giving them, right? Market started pricing in skip, and then Fed delivered the skip. So no more rate hikes, which was a little different. I thought maybe they'll still do 25 basis points because other central banks have done it, and the inflation is nowhere its target of 2%. But FOMC will do what FOMC will do, right? So for now, no more rate hike. I think that's all was already priced into the market. We saw a little bit rip higher on Friday maybe start of the day. Eventually, I think at the end it was probably the same. But I think the vote was unanimous, and all FOMC saying, hey, we will wait to see additional data. I don't know what additional data they're waiting on, but the messaging was really not very, it was a little confusing to me that we're going to pause it now, we'll wait for data, but then we could hike it twice by the end of year. If you know that it's already 4% and we are pricing in, and then they're saying they're going to be maybe a soft landing. They'll try to steer a soft landing. There are chances of recession. If there are chances of recession, then how are you going to hike it at the end of a year? That doesn't make sense. So might as well could have done it now and should have given a message to the market saying, hey, we are done it now, and then we are done for the end of a year. We'll see only if the inflation rise its head again. We'll look at it. So far, the inflation trend has been down. It's a weird thing to think that it is down. It is down means it is still increasing, but are not at the same pace. So for now, we get a pause, and it's trying to temper the enthusiasm, saying there'll be two more hikes, but market is not pricing in. Market is pricing in only one more hike. So, and we saw after this, animal spirits were back in the market. We talked about kava. I think I do have somewhere. Anyway, we'll go through. We talked about kava last week, or maybe a week prior to that. Oh my God! If you follow its IPO, I don't know, call it a success or a failure. In my opinion, it failed miserably. But the media is reporting it was a very successful IPO. It is up 117% after listing. Animals are back in the market. Ross, inflation rate is down, prices remain inflated. Yeah, this whole the inflation numbers seems like a joke to us. Right? If you heard Kroger CEO in their last earnings call, he was very clear that, hey, we have a pricing power. We will continue to, they will continue. All he said was that they have a good pricing power, right? And if you translate that into the impact on us as a consumer, that means, hey, they could continue to raise the prices. So I don't see any let up in the prices. I would say except homes. I do see home prices have come down in and around our area. The prices that we had seen last year, now those prices are down 15%, 20%. Of course, I think in the last 4 or 5 months, it has risen, but not where it was, let's say, last year. Yeah, homes may have bottomed. That's what I saw. I think like January, Feb, at least in the Bay Area, when I look at the Redfin and all that, I see that the pricing bottomed at around in the Bay Area around Jan timeframe. And after that, it has gone up. But it is still down from where it was, let's say, somewhere in last year. So that I am seeing. I am seeing houses under 2 million showing up, single family homes. I know if you are in a different place, the scale, the measuring scales could be different, but it's after a long time. Now I could see areas around here, I mean, around 2.2 million, 2.4 million single family homes after a long time. They were never like these. Len says, not in Toronto. Yes, not in Toronto, maybe. Yeah. Oh, that market is completely crazy. Even worse than, I would say, a Bay Area market. So Dave, property went up another 10%. Yeah, maybe in last 2-3 months. That I've seen. When I'm looking at it, the curve is going like this. It was going up, and then it rallied down. Here, this is like a Jan time frame, Jan, Feb time frame, and then a little, started to go higher, but it still hasn't reached a previous peak. Again, mortgage, at 7%, it's so difficult. Right? So a quick look at the sector-wise. Can we imagine June was like 6% delivered on SPY or SPX overall, and year-to-date is almost 14%, 15%. I think SPY is around 15 point some percent. So congratulations to all the investors, those who had to put through 2022 and stayed put. So far, so good. Right? Look at a NASDAQ QQQ, unbelievable, almost 40%. And I think it's only maybe 1 or 2 times in the history of NASDAQ that it has given return more than 40%, or maybe 3 times. We looked at the chart. It doesn't happen every year. So this is an anomaly that NASDAQ is up 40%, and we are just in 6 months. Right. So, but I'm a little concerned that for me, it's too much too soon. If tech layoffs stabilize, see housing market will shot up again. Agree. I know some folks who have to leave the country. They actually bought their house, and with this whole tech layoff, they were on visa and now have to leave the country. And now they're looking to rent it out. If rent doesn't work out, they'll probably sell it on. Yeah. But tech layoffs, stabilization, there was an interesting chart I saw. I don't know if I have that here or not, or maybe I can search. Today I went for a hike with my friend, and he told me it's on Bloomberg, saying the type of jobs that will be impacted by McKinsey report, AI job. The type of a job that will be impacted by AI will be all knowledge workers. A lot of them coming from the tech sector, a lot of them coming from financial sector. So I haven't read the whole McKinsey report, but let's see if I can find a chart here. So this whole tech layoff, I don't know when it's going to stabilize, because right now every tech company is looking at why can you not be, 150% productive of what you were earlier, because there are a lot of new tools that allow people to become more productive. So let's see if there's not this. Oh yeah, this was a chart. I only saw a chart in Twitter. My friend told me there's an article on report in Bloomberg. Maybe I'll read it later. So what they say, with generative AI, without generative AI, share of the work that can be automated. Masters, PhDs, 57, almost 60% of the work can be handled by AI. Right? So mostly around the knowledge workers. Now, what AI cannot replace, and this is where we are finding, I think there is still a lot of a job demand, is the real vocational habits, right? Hey, plumber, AI can't fix your faucet. They can't come and fix your any electricity problems. So electricians, plumber, the real work. So there's been a chatter on the market that we had an industrial revolution. This AI revolution is going to bring back and flip the tables, that the industrial workers will have a higher demand than the knowledge workers, which has been so far over past couple of decades, is the knowledge workers that have been winning the job market. It's going to be flipped around, which is, hey, if do you work with your hands, you probably will be more in demand, because if you're a knowledge worker, a lot of work can be outsourced or be impacted by AI. So that's a little scary. I hope by that time I'll be done with, I won't have any more need for a job by the time it impacts me. But I think for the next generation, yes, they have to be careful. Something that can be automated will be automated and will be replaced. So that was a little scary chart or the numbers. Right? A lot of financial advisors. I think I have one article around AI-based ETF. So we'll go through that. So the one question that always come up in discussion is, hey, do you think we can just automate our investing? Right? So that we don't have to pick and choose. Already there's, I think, as the hedge fund sector, most of the trading is anyway done through computers algos. But as a retail investor, as an individual investor, do we think is there a space for AI to come and manage portfolio for us, right? Or the other way around is, as a financial advisor industry, do you think the financial advisor will become less relevant in age of AI, when as a Fidelity portfolio management group, I can apply and use AI models to construct a portfolio. Then I don't need 10 financial advisors to create a portfolio for the clients, right? Maybe we'll have some financial advisors that will answer and talk to the clients when things go bad, but we may not need the same number of people to construct portfolio and run portfolios and manage it, right? So we don't know. The jury is out there. There is a lot of trials. There is one, actually, an ETF, and I will look at that ETF. We'll go through that ETF, which is based, and that ETF is the stocks in that ETF are picked by AI. Has anyone bought that ETF? There's a startup business. Instead of hiring people, just hire AI. Yep. On the big guns already using proprietary AI already. The latest AI is for retail investors. Yeah, that is what I was referring to, is saying, hey, as a retail investors, can we use AI? All right, fear and greed index, it's still moving to extreme greed. I start to see these screenshots popping up again on Twitter feed, and of course on YouTube also. Hey, I made 100% gain, 86% gain, right? Whatever. Just as a reminds me of 2021, where everyone was touting all these huge gains that they are seeing in the portfolio. So when everyone is talking about it's all good, I think it's time to be a little cautious. I'm a little bit contrarian. Not that doesn't mean that I'm going to dump my portfolio, but just mean, hey, let's make sure we continue to have our hedges on and protect our coffee can portfolio, right? Don't want to end up in a situation where I end up selling some stock, saying, hey, I want to sell the stock now, I can buy it later, right? Haven't we done that many times? And then realize I forgot about the stock, could never buy the stock, could never pull the plug, and then stock gets run away from us. This week was again a reminder for me. Oracle. I'm like, dude, this is a stock that we had analyzed, talked about the stock in this meeting when it used to be around $40, somewhere over here, right? Over here, 40, $50. And I started building my position 40, 50, 60. And but unfortunately for me, that was in my account that I had just opened to try stuff out, which was my Robinhood account, because a lot of my friends had Robinhood account, and I was like, no, that's not the best way if you're especially doing options. Don't use Robinhood. And they're like, hey, the Robinhood is a free. No, it's not free. You pay a lot from back pocket. So before I criticize something, I thought it's good for me to actually use it. So I opened Robinhood. I added Oracle over there. And last year, I just wanted to clean up my Robinhood account. I sold my Oracle. It was good. I sold, I think, between 80 and 90. Then, yeah, I'll buy it later in my other portfolio. And then I forgot about it. I didn't put it in my coffee can portfolio. I didn't put Oracle in my coffee can portfolio, right? So you could say it was a great run, right? From 40, 50, all the way to 80, 90, right? Take your profits, take your gain. That's what we always hear, right? Hey, take your gains, move it off, take your gains, and no one has gone broke by making profits. Even I used to say the same thing a few years ago. No one has gone broke by taking profits. But now I also add is no one has made immense wealth by taking profits, because we end up taking profits too soon. And this time when I heard Oracle results, like is it like 120 plus? My gosh, I was bullish on it. I had positions on it. Just I cleaned it up, saying, okay, I'll buy it later, and I forgot about it. I'm like, I'm not gonna do that, right? So lesson learned for me. And this has happened many times when you try to say, okay, I'll sell it now and might buy it later. But psychologically, you can never, it's so difficult to pull it off. So for me, I'll hold my stocks, sell and hedge it rather than trying to, sell I know there are animal spirits in the market. I am cautious about the market. I'll probably hedge my portfolio in other ways than trying to sell the shares and incur capital gains. Right? Yeah, little bit of story around Oracle. Ramesh says, "Yeah, loved it, didn't buy it. Oh, I bought it, and I almost made double the money. But then I just wanted to clean up my Robinhood account, so I sold everything that I had in my Robinhood account. Oracle was one of that position. JPM will use AI to replace their bank branches. True. I think all the I would say the regular jobs that we do in the bank branches, yeah, probably will go away. All right, so little bit buys and sells happened this week for me. Again, this is I share in term just to be transparent because we talk about a lot of stocks. So I bought SC. I had a short put on this is South C Limited, not South C. Gosh, this is C Limited. If you recall, way I think months ago, I had talked about that I'm going to sell covered call on C Limited because I haven't actually studied this really well. I bought the stock because, hey, the stock had fallen a lot. So I bought it and then I sold a covered call at around 63 or 65, right? And the stock, after I sold a covered call, stock shot up to 75 or something. I said, I'm not going to defend it. Let it get called away. I'm like, I don't even know the name of the CEO. One thing which I have now tried to do is, if I don't know the name of the CEO, then it means I haven't really studied it. I haven't spent time in owning the stock in my portfolio. After they got called away, I was listening to I think I was listening to some podcast where they were talking about a company, and there was a reference to C Limited on the turnaround strategy. Then I thought, okay, I need to spend some more time. Went back, started to study around C Limited, looked at what they have done as a company, how the CEO and the management, they are turning around the company, what are their plans, how they're running the rest of the organization. Then I said, okay, now I think I deserve this stock in my portfolio, and I sold a put on it, right? I sold a put back at, I think, at 63. Now with the stock came down, and I get the stock back in my portfolio. So I have no complaints, but just let you know why did this came back in my portfolio. Steve, sell stocks, all right. Sell deep in the money, covered weekly calls. Yeah, if I'm put time in to know the stock, then at least this year, not even this year, I think over the last 12 months, I've decided I want to clean up a little bit of my portfolio. Don't want to have 120 stocks. At some part of it, I did, but I want to have the stocks that I know, right? And one of that condition is, again, your mind needs some tricks to do the right job. One of the condition is, hey, if I don't know the name of a CEO, then it means I really haven't done a good job. So I have to spend time to understand who the CEO is. Rather, more is to spend some time learning about the company, right? So if I don't know about it, I'm like, okay, I don't deserve to own the stock. The stock may be great, but I don't deserve to own it because I haven't done my homework. So I can't build conviction on the stock. Right? The stock goes higher after I owned it. I could have been plain lucky, right? If I haven't spent time on it. It's only if I spend time, I understand business, stock goes okay, then I can say, oh, this is I can take some credit. Otherwise, it's just plain luck. And believe me, many investors treat their luck as their ability. but then we realize it in a very hard way that what happened was just plain luck. But for all the stocks that I know and I hold in my portfolio, why I hold in my portfolio, yes, I'll continue to sell monthly calls. Weeklies are too much for me. It's too much to, I don't think I can do weekly along with my job. Yeah, so I got SE back. All these, I had a call spreads or a covered call on those. So I sold some shares to buy back some of the calls. On Palantir, I think I let some of the shares taken away from me. Palantirs are up like 200%. I still own the coffee can portion of Palantir. I'm not gonna touch that. Same case with Magnite. I let the shares taken away from me. Meta had a call spread. I bought back the call spread, sold some shares to sponsor that buyback. Same is the case with ASML. Same is the case with Amazon. Same is the case with TSM. So got some stocks, sold some stocks to sponsor the call and call spread buyback. Ross, luck is not equal to skill. Yeah, you should have seen in 2020, 2021. Everyone was a skillful investor as Warren Buffett. But unfortunately, that's a hard lesson people learn. Hey, I bought a stock and it's up to 100%. I mean, Palantir, if I had not done the homework on Palantir last year and have gone to review the Palantir, I think it was early January. And then I come and talk about it, why I'm bullish on the business of Palantir, right? Stock was still at $6 or $7. I had no idea that the stock is going to go, what, $14, $16? But when we look at its quarterly results, how they're changing their business, the business mix, their products, I'm like, this company seems to be deserves more than what it was trading at or the valuation was. That's the only thesis, right? And I held it. Now we see AI crowd coming in and talking and kind of a pumping Palantir. It got called away at 14. I'm perfectly happy at it. I still have my coffee can portion holding it. Probably now, I think I already sold a put to acquire it back. And if that happens, rinse and repeat. I'm going to hold it for a long term. Unless in the next quarterly result, I find something else which is, oh, that doesn't look good, right? The intention of selling weekly is to let it called away instead of selling the stock outright. Yeah, that could have been done. So I think the one which SE probably was, the way I sold SE was through a covered call, I guess. It was a at the money covered call. Not that I just sold the stock. Probably it was at the money covered call because mine was, I don't want to hold it anymore, let it get called away. All right. So since we talked about AI, what do you think? Has AI crossed that proverbial chasm? Right. In every product life cycle, we see this where initially it will be the innovators who will adopt it. Then you have early adopters where you have just an MVP, minimal viable product or minimal feature set. Then the third one, which is a green area, is where we get where we build the whole product market fit and create the big solution. I think product market fit happens even in early adopter, but this is where we start to create the whole product for the mass market to use. The question to you guys is, do you think the AI has actually crossed this chasm? Because this is an area proverbially called as the chasm wherein many of the companies will just die and fall through this. Right? Strong early adoption, a lot of hype in the market, a lot of people are trying it out, talking about it. But the moment you say, hey, you're going to pay me for this one, we're building additional feature sets, they just can't move to the next level. Now the question is has AI already crossed it, or we think that the AI is still over here? I think it is beyond this. For me, my thinking is AI is still over here. I think the real use of AI for running the businesses, there's a lot of talks that have happened. There are a lot of POCs that are going around. There are a lot of companies that are getting funded, but the real impact we still have to see where you move into this green area. So I'm being a little cautious around all the hype. Ross is number 2. Yeah, I have the same opinion. I'm a little cautious around all the hype and the gains that we are seeing in the AI. Everyone is now turning only to the one side of the board, right? Which is all investments going to AI, all private investments going to AI, all public stocks that are working are all related to AI, as if nothing else matters at this point of time. And these things will correct, but correct doesn't mean that it's going to correct tomorrow. I think the dot-com bubble stayed on for 18 months. So, but when the correction happens, that time, there's a lot more pain coming in. So I still believe it is there, but we also saw AMD came and talked about its own AI chipsets. So AMD came with a new Instinct series, which will be used by these chat GPT and these chatbots. So if you are a tech company and you're not talking about AI, a tech company and you're public and you're not talking about AI, Wall Street doesn't want to hear from you. Steve, ChatGPT costs me $20 per month. Yes, and I hope you're making some good use of it. And I'm not sure if the winners of AI will be ChatGPT. It's too difficult to predict the winners so soon, right? If you look at it, so right now we are thinking Microsoft and Google's will be the winner. Given the current breed of the tech companies that we have, possibly. But there could be many companies that would be coming around and could upset them. It's difficult to see it right now, as much as it was difficult to see it in 1999, that Google will come in 2003 and render all the other search engines useless. I'll be aging myself, but I still remember, searching on Alta Vista. Ask Jeeves, the butler guy. I think, yeah, that was Ask Jeeves. Lycos, of course, Yahoo. Google was, if I remember the number correctly, 23rd search engine. Google was 23rd search engine, right? It wasn't the first one. So, and from an AI perspective, I don't know which other will be 23rd, may not be 23rd, but I'm not sure if the first one is in AI, which is like large language models, chatbot, which was done by OpenAI, is going to be the winner. We just don't know. And I don't want to pretend that I know that. I think we're done with that AI. I think a lot more changes might to come. One fact about the Google is they have to be, they have the whole power. They have the scientific power to rule the AI world, but they have to figure out challenge between the search and the AI. Right? It will upend the traditional way we are searching. So it's Google could end up into the same dilemma that Microsoft was, that if we want to then win the next phase of the company, you may have to kill your current, or you may not have, you can't feed your current cash cow. Microsoft was in dilemma for long before Satya came in, because Windows was doing so good. If they want to invest resources on and convert it into cloud-based, they had to basically reduce. There was a risk to of reduction in revenue from Windows. And Microsoft were all focused on protecting that cash cow, right? Unless they realize, and when Satya came and said, guys, if you have to win for tomorrow, we have to kill our or not feed our best product for today. What is it called? Innovator's dilemma or something like that. There is actually a term for it, right? The best innovators kill their own products to win for the future. Google may end up into that situation. Right? So we'll see what happens. Other thing around AI, also saw AI powered investing. I think something that we were talking about a little earlier. Sam says never used Ask Jeeves. I think I remember using Ask Jeeves. And asked, I think it was what, 2000? Year 2000? I guess so. That was, yeah, I think that was my first, no, yeah, probably 2019, 99. And Ask Jeeves was more like a very, very, very primitive model of a ChatGPT 3. It was you were supposed to ask the questions to Ask Jeeves, and it was supposed to return you the answers, right? It was little different than, let's say, the Yahoo search, but that was what it was supposed to be. Of course, we never had the technology of LLMs. We never had these processors to do a good job, and it never went anywhere. And after Google came in, it ate all the other 22 search engines. Dave used daily at work using Power Automate. Great. Add our collective cost to. You can construct a portfolio using ChatGPT. No one uses ChatGPT 3 anymore. So how do you construct a portfolio, humor Steve, on ChatGPT? We all can learn from each other. I've not tried to do this. I tried to use ChatGPT to get some real numbers, but then I realized some of the numbers were actually not right. And then I had to go back and double check it. Then I said, okay, I'm not doing that. But yeah, I use ChatGPT to get some generic information. Yeah, if you are okay to share, maybe first in terms of how you're using to construct the portfolio. Sam used Google 1998 for, okay. Yeah. All right, let's talk about AI powered investing. So what happens when you have an engineering director from Intel, a VP from Fidelity, and an investment portfolio manager for Apple? They all walk into business school. Hey, let's create an ETF that is managed entirely by AI. And so we have an ETF. In 2017, they came up with an ETF, AI EQ, world's first fully equity ETF managed by AI, right? They have around $60 to $70 million in assets, not too big. And they use 80,000 models to analyze approximately 6,000 companies. Oh, sorry, that first year it was 60 to 70 million. Now they have $150 million in assets. It's a very small slice, but it's a start. And they have almost 80,000 models. It's run by a bot called EchoBot. And at the high level, they basically get signals based on financials, news, management, overall macro, and then you score each one of them using those different models. And then you say, okay, which is the one that we want to use and buy it and hold it in our portfolio, right? So yeah, rest is the same. I mean, so let's look at how is that working out. 80,000 models, impossible for human to consume that much of information. So if you're interested, this is the ticker AIEQ. expense ratio is really high. Understand why it is. What are the latest holdings? So performance, year-to-date performance, 3.5%. No, this NAV per, yeah, 6 months negative, 1 month 7.3%. So far, I think I would rather just hold SPY. Hasn't done that great. What are the top 10 holdings? Morgan Stanley, Goldman Sachs, Dexcom, DR Hortons, United Rentals, Plug Power, Public Storage, Monolithic Power, Dick's Sporting Goods, Corvo. This is what AI has picked. I don't know if they have maybe we'll have a longer performance chart. Let's see if we can compare on Google Finance. AIEQ. Alrighty, let's do Max. It's been there since 2017. 2017 to now, it's up. So far, it's up only 23%. Not that great. Let's say last 5 years. Now, if we really look at it, all your AI models, eventually, I mean, it's almost replicating what the SPY is doing. At the end of the day, after employing 80,000 models, even if you look at the trajectory for since 2018, last 5 years, it's just almost the same as how the overall market is doing. So I don't know what this, yeah, so it's interesting. I don't know what this, I mean, is there any value of paying 75 basis points to get this AI-driven portfolio? Okay. I would have been okay if, hey, it could have protected in the downturn. Doesn't look to be. This whole 2022 downturn, no protection whatsoever. It's just almost day-to-day basis, the ups and downs are just mimicking what the overall market is doing. Then what the heck are you charging me 75 basis points for? Okay, now looking at this, I'm not interested in it. And this is where I don't know whether AI will be able to replace, assets for retail investors. How am I going to use it? Is it going to really impact my decision making? I haven't seen the evidence for it that AI is actually, after putting it together, I'm like, it just is making SPY. Right? Those financial advisors should be looking for another job. Being interesting is stacking that up beside the return of a mid successful ETF. A chat GPT-4. No, but I'm yeah. So I don't know about this AI, right? This AI ETF has been around since 2017. Yeah, maybe 5-6 years is not good enough to measure performance. I agree, but probably we'll see a few more AI models coming out in next few years, and then we'll see how those compare against the market. Right? So the tech has always been ahead of individual investors. 1950s, no computers. I think the folks like Warren Buffett, Benjamin Graham, if they have to study a company's financials, past financial, you have to go to the library, go and look at their quarterly reports, and then do an analysis by writing down a piece of a paper. Right? During that, and when computers came in, these things became much more easier. Then internet came in, right? More and more technology continued to come in. But even during those time frames, we haven't seen most of these fund managers who deploy all the tech being able to beat the market. Could this new breed of LLM and AI could beat it? Jury's out there. I don't think that we can decide right now. Right? The proprietary AI models of Goldman Sachs, hedge funds of the world haven't beaten it, haven't been able to beat on an average. There are obviously 10% of the funds or the fund managers that will beat the SPY, but for retail investors, we don't know which are those 10%, right? We run a big risk of the rest of the 90%. So as a retail investor, shall we be good with holding the market? Probably, unless you have interested and know about an individual stock. AI has data from decades and they could not even beat. Yeah, I mean, this particular one, yeah, they were, yeah, couldn't beat SPY. No, beating SPY is a different one. What I'm more surprised on this ETF is that the direction or the movements in this ETF is almost 100% correlated with the SPY, which is what I would thought if you are deploying these AI models, you would be able to do something different than what the overall market does. That is, for me, that is probably more surprising. It's just takeaway from this picture is it's just mimicking the behavior. Right? Beating could be different in terms of how much risk you have taken. So risk, your returns are always adjusted to the risk. If you have taken the risk way less than the market, obviously your returns will be less than the market, right? But the behavior of this or the variations of this AI, which is matching or mimicking almost day-to-day basis on SPY, that's a big downer for me. I'm like, that doesn't make sense. Anyway, that's a AI EQ. An ETF created on using AI. What else they do? They use internal tools. They use IBM Watson's. That's the first AI available. IBM Watson started with their AI initiative a couple of decades ago, and they use IBM Watson also. They have a model that uses around 170 line items and all that. Judgment is not AI's strong suit. That is true. If you believe AI will best human AI-powered portfolio will beat SPY. Human plus AI better than pure AI. That is one. That I do agree. Okay. We'll see. I'll wait for that portfolio or any ETF. Which could consistently beat SPY and taking less risk than SPY. I just don't want to beat SPY. Right? Everyone would have, a lot of investors had beaten SPY in 2020, in many other time periods. But the idea is how much risk did they take with respect to the risk in the SPY. So risk-adjusted returns, if you beat SPY, nothing like it. But I have yet to see. All right, next one, want to look at Charles Schwab Modern Wealth Survey. Right? So they surveyed 1,000 people. So not a big sample size. Well, let's see what those 1,000 people across the different age groups think about. So Gen Z, Millennials, Gen X, Boomers, and 46% male, 53% female. Mean income of these 1,000 households were 81K. Median is around 68K. Investable assets is 258K. Median is around 75K. So some of them have really, really big savers who have pushed this mean or slash average higher. But around most of the people, the majority of the people have 75K worth of investable assets, and 50% working full-time, 17% retired, 21% maybe own their own business or something. So what does money mean for Americans? 42% says freedom. Freedom from, I guess, taking orders from your boss. Freedom for your time. Right? Today, if you're working, I don't care how highly you are paid for that job, but we are exchanging our own time, and everyone has a limited time on earth. And I know billionaires are trying and funding a lot of biotech companies that could make them eternal, but hasn't happened yet. I don't think going to happen in next 20, 30, 40 years. So everyone has a limited time, and we've been mortgaging our time to make money. So the almost half of 40% of Americans feel what money will give them is a sense of freedom. Right? I can be boss of my own time and don't have to take orders from anyone else. For their personal values, as you go towards the younger generation, they put a lot more emphasis on my own individual value. What do I value more? Right? I see this among our friends in my own family. The younger generation cares a lot more about environmental impact than, let's say, I would. Right? And looks like a lot of that, as you move towards a younger generation, more and more people also decide their investment, base their investment decisions based on values. Right? Personal values drive their decisions. 21% say, hey, we want to earn this or save it because we want to do good for others, focus for family and friends, do best what's for children. We want to be frugal, focusing on the self, 13%. Right? What else do they see? Factor important when making a purchase, 94% price, no surprises here. Features, 76% says values of the company. What company does, how the companies present themselves to the society. And that is why we are seeing more and more companies now being more active on societal issues also, because that also is conveys to the people in terms of what that company's values are. Factors impacting investment decision: companies, performance, risk, stock price or fund, company's reputation, company's values or funds. 81% says that their investment, company's values or funds values is important factor when deciding for which company to invest in. Next, what is considered as wealthy? That's important. To be wealthy, it's $2.2 million if you want to be wealthy. So average American is already out of wealth. Right? To be financially comfortable, I think $750,000 is what the survey reported. And it looks like the numbers actually came down from 2018. I think this might be an impact of a COVID. COVID taught a lot of lessons to, I think, everyone in terms of where to focus on in life. It told us doesn't matter whether you are in the most developed country in the world or you are staying in a third world country. Unfortunately, US had the most deaths around through COVID. I agree, some other countries don't report it, the right data, but we can only go by the data that we have. So that does tell us it's not only about money. So we did see from 2.4, 2.3, 2.6 million. People are now being okay with little less money, but still 2.2 million is really huge. It takes much less to be just comfortable with your life than to be wealthy. And I think some of that wealth concept is also you're trying to catch up by catch up with your neighbors or catch up with your friends. Right? If you want to live in your own comfort, you probably need 1/3 of it. So that was a quick small survey. Charles Schwab, I guess they do yearly survey, but this is the first time I read through the survey. Okay, one of those cold storage brains went bankrupt. Okay, we'll read that later. Gen Z will use credit card to buy a new iPhone 15 instead of paying off student loan, according to recent SoFi study. I think that has to do with the iPhone. Right. There are people who will be able to sell maybe one part of their limb to get Vision Pro. There are some crazy people out there. There was an interesting stuff. I don't know where I read it, but I didn't know about it. But there are something called not iPhone, iFamilies, which means anything and everything that they own is all Apple products. And there's a group of such families, right? You don't get this. I think Tesla is another brand which has a similar brand affinity, where you have a Tesla owners very passionate about what they own. They meet often. They have their own community. I don't think any other brands command that sort of a loyalty from their customers. Sample size may not be statistically significant. Agree? Yeah, it's only 1,000 sample size. A lot of that is influenced by WEF. You will own nothing and be happy. It won't be bad. I mean, owning a lot of stuff and being miserable is not the style that at least I would want to live with. If I can live with the fewer possessions and be happy, I would rather take that path. But I guess everyone has their own individual beliefs. Doesn't sync with the housing prices, though. I don't think they talked about housing pricing in this one. But yeah, millennials are priced, or Gen Zs and millennials are kind of priced out of housing. Pretty crazy. But one other thing, not related to investing, I feel the younger generation, millennials and Gen Z, is also more health conscious than what my and let's say I am Gen Xer. I don't know prior to that what baby boomers, or there was something in between, that we are not that health conscious at all. But the current generation is pretty, it's health conscious. And that shows up in the numbers. They drink less, smoke less, and eat healthy food than what I guess the Gen Y or Gen Xers were doing. Alrighty, let's talk about a little bit on options. Getting into the weeds to talk about some strategies around adjustment. But before that, I think this whole 4th of July, not this one, the 16th June weekend was one of those weekends where you have those triple witching. A lot of options expired, almost 4 trillion worth. Interesting stats were 70% of those were 0 DTE or 1 DTE. That number was from Thursday. So on Thursday, numbers were that there are 4 trillion worth of options expiring. 70% of them are either expiring on Thursday or on Friday. Isn't that crazy? This whole 0 DTE has taken, I guess, a lot of these options day traders by storm. This week I happened to pop into one another meetup. I had to drop my kid and was taking evening walk, and then I said, okay, let me see if there is anything interesting on a meetup that I can find. And the folks in that meetup, there's one person who's like a full-time trading options, and then I asked him, how much they do expiration do they do, and they said 0 DTE is his game, right? And 0 DTE has been around for what, only 18-20 months, last March or somewhere. It's a crazy. We are seeing so much volume coming in on these 0 DTE options. Is now sometimes I start to wonder, is it the dog wagging the tail, or is the impact of these 0 DTE options changing the stock prices? The volatility that we see in the stock prices could be because of these very short dated options that are now become a rage with many traders. But some interesting stat. We talked about velocity of risk is on the upside. A lot of call buying happening, and that make calls more expensive than puts, which is generally reverse of what it would generally be. Maybe a lot of folks are doing stock substitution, short covering, FOMO. Gosh, we've been sitting around. Like if you're following Mike Wilson from January, it's been saying that SPY will hit 3,200. And if you have stayed out, many fund managers could have stayed out because Treasury is giving 5%, right? You really have to justify the risk that you take when Treasury is giving you 5%. And if you are managing huge billions of dollars for a pension fund, for an endowment fund whose hurdle rate is 7%, you can just get 5% by investing a bunch in the treasuries. And then all you need is additional 2%. And why risk everything by putting in the market? So if a lot of those folks who have stayed out and now getting in, that could be FOMO. So at least I feel some FOMO is going around. I feel, especially looking at a Kawa, it's animal spirits are back in the market. For me, time to be a little cautious. June option volume was the highest ever in history. Yeah. So let's talk about some adjustments on how you adjust. But let me just figure out any other topic you want to talk about. So I had two things. One is adjustments. The other thing I want to talk about exercise, because I just went through the process of this early assignment Thursday. Yes, then I thought maybe I should talk about it on how to manage or how you keep an eye on this one. So these were the two things I thought we'll discuss. If there's something else we want to talk about, let's bring that up. Actually, it is better than 5%. It was 6.25. 6.25 from Treasury Direct. Which ones are you talking about, Steve? Are you talking about I bonds or are you talking about T-bills? I didn't think any T-bills are offering 6.25. Treasury auction. Hold on. The recent auction results. Now 4-week is 5 point of like a week. Oh, is that the one that Treasury came up for 3 days, etc.? Because generally Treasury has the minimum is for a 4-week. I don't think I've seen anything below 4-week. But for June, during that debt ceiling drama, I think during that drama, Treasury offered one special kind of bills that was, I think, paying more than 6%. CMBs. No, even the CMBs, the recent auctions have been around 5% or something. But in any case, I think that the point is, if you can get 5%, then what you call equity risk premium, right, looking at where the SPY is right now, is not really favorable. How do you justify? And if you are held accountable to meeting your minimum threshold of 7%, if you don't meet 7% threshold, you kind of you could lose your job. If you make 10%, 12%, you may not get the additional bonus you get may not be that great. Then as a fund manager, I will say, let me make sure I can make minimum hurdle without the risk and the reward. I can still meet the minimum hurdle without taking too much of a risk, and could have stayed out on this whole rally. Again, these all are guesstimates. A lot of these decisions are also driven. Eventually, there are fund managers who drive this decision. Those are also get paid. So great, they look after funds. They also have to look after their own well-being, right? And that's what happens, right? That's the reason why all the mutual fund managers, portfolio managers would want to make sure that their fund returns look good at the end of a year. As us as a retail investors, we don't really have to care about a year. Year is an arbitrary date, but fund managers do have to, and they may take up some short-term decisions. Maybe, hey, let's sell Tesla or sell Nvidia or sell Microsoft or anyone right now and lock in the gains so that I can show and realize those gains, right? We don't have to do that. Yeah. All right. So let's jump back to adjustments. Anyone have gone through experience of, hey, I did an option trade and that went against us? What adjustment techniques do you use? Anything to share? Anything to talk about? Or you never had this issue of even trying to adjust any option trade? Sell in the money call. So David, sell in the money call for what kind of option? Okay, day trade sells Tesla. If it goes against me, you sell in the money call. Okay. So that's like if your stock goes against you. When it says roll to the next, I guess that's a roll of a strike or roll of period, or roll out to the next month, same call. Okay, so that means you sold a call and then you're rolling it out to the next month. Yeah, rolling out is another one. Stay in the trade, give yourself more time to be right, roll it out the next month and see if stock cooperates, could come back. Had with C Limited, right? Roll of time and strike. Yeah. If you own shares and sell covered call, it goes against you, sell the same strike or above on the put side. Yeah, that's a pretty common one. Even if you have sold a covered call, or even have sold the put, I think this is pretty common one. Is I'm not sure if it is common one, because many of the retail investors do the opposite. Is they try to change or touch the side. If your call is getting challenged, you try to do another call on the higher side. If they bought a call that's getting challenged, they do another one on the higher side. But the beauty is to maybe touch or at the side which is not on the challenge side. So there are a few options, I would say, that are available to us is like to say sell, buy more, third rollout. Yeah. So maybe let's look at some of those and talk about it. So let's draw some P&L diagram and see how those things work out. Will that help? Okay. All right. So let's draw our call where we sold a call. So how does that look like if I sell a call against a stock that I own? Let's say this is my strike price. And if I sell a call, this is going to be my P&L. Strike price for here, and I collect some premium. Oops. So, oh, this has become too sensitive. So this becomes my break-even point. This is your P&L diagram. Now, this was your strike price. The stock was here when you sold your call. Now the stock has come and has reached here, right? Stock has reached here. So let's look at all the feedback. One is you close this particular trade. So when you close this trade, you'll close this at loss because you have to buy back this call, which become expensive because the stock has moved up. And then as a next step, you open for next month. So that this is called roll of a period, right? Give yourself additional time. And when you do this, you collect additional credit, means it gives you a little more buffer. Second option is if a stock is here, might looking at selling a put here. When you sell a put here, you convert the only call to a strangle. But when you sell a put, you collect additional credit that pushes out your break-even point to further down. That's number two. There are different periods when we want to follow one versus another. I think we talked about during the whole boot camp stuff. I generally will not roll out until I am, let's say, around 15 days, 10 days to expiration, right? If I am 20 days to expiration, 30 days to expiration, I'll first use this and then maybe roll this up this. And then if it is like 10 days to expiration and I still have the same outlook towards the stock, then I'll say, okay, let's give ourselves more time to be right. Move this out, close this at a very, buy it back, this one at a very, fractional price. So you get on the put side, roll it out on the call side, and give more time. That's how the method that I follow, which is to gain more premium, reduce the risk, and then you roll it out to gain more time. Third one could be number 4. It says, yeah, do nothing. Could be a choice, but it depends on how far the stock has gone. You want to do nothing is, yeah, in some cases I have followed. I'm not going to adjust my positions the moment stock is moving against me. When I opened the position, stock was here. Stock has come over here. I'll still wait. I'll not do anything. Stock come over, I'll still wait. The other way to look at it is the delta. If you have sold this the stock at this strike price, and when you did the trade, it was at a 30 delta, which is generally I follow for, let's say if I were to do a covered call, 30 delta, 20 delta. and now the stock has gone up, and the stock has gone up, and this delta has changed. Now, how do I bring it back to, let's say, 30 delta? Is I could look at the change in the delta also. That's another way to look at is, hey, my deltas have gone, have changed. Now I need to regain or bring it back to my original deltas. So there are two ways in which traders take a decision. None of them are right or wrong. I think it's based on what works for you. And how much time do you have? Because the delta will keep changing with every movement of the stock. So if we have a lot of time to go and continue to adjust it, yeah, maybe look at your delta as your driving factor. I will generally look at hey, how far the stock is from my strike price, and I'll take a decision on, do you think it's going to continue this? It's going to continue to challenge me? Or if it is, do I still have enough time left or not? And then make a decision on this. But I guess, yeah, so whether if you sold a call, sell a put, roll it out. If you sold a call spread, maybe do the same. Instead of selling a put, you sell a put spread, same width as a call spread, so zero additional risk taken. But by taking additional premium, we have reduced the overall risk in the trade. And so if my starting trade was, let me just get rid of this. Let me know, is this helpful? Yay, nay? Should we go into details? Okay, see, yes. All right, yeah, so I had a thought of maybe we talk about short call spread, put spread, strangle, and ironfly. All right, so let's talk about the call spread. So when you sell a call spread and you collect a premium, this is your P&L graph, right? You sold a call when you sell a call spread. Okay? Now stock is here, moved over to here. If you want to adjust it, sell a put spread against it. That becomes your, convert it to iron condor. You get more, when you sell this, you get additional premium. So if your risk, when you open the trade was, let's say, if this was a $5 wide spread, you collected, say, $1.25, your overall risk was $375. When you sold this put spread, you might collect another 50 cents. So now your overall risk is only $3.25. So you reduce the risk. That means you pushed out this break even by further down. Say it'll be the opposite case. If you have started with a put spread and then you're moving and that has gone against you, just the opposite way. You have to start with the put spread. This is your P&L diagram. You thought that the stock is gonna go and stay higher, so you sold a put when stock is either go higher or stay where it is. You sold a put when the stock was here, stock came down out here. All you do is sell a call spread, convert it into iron condor. Almost same logic, get additional premium. It pushes out the break-even point further down, reduces your risk by the amount of additional premium that you have taken. Short strangle. So this is the strangle trade. Let's say you started with the delta neutral. This is your call side. This is your put side. We start with the neutral. Stock moves here. Oh, my call is being challenged, right? do the same thing, move the put, collect additional premium, which moves your break even to further down. Almost the base is still the same. The idea is to collect more and more premium to reduce the risk in the trade, right? Doesn't matter. So if your call is being challenged, if you try to touch the call, you have to pay money, right? At that point of time, we are kind of, I know the market has gone crazy. I know that is not, that is going to go further down. So we become very, deterministic. Options are all probabilistic. So rather than me trying to take or invest more and with the thought that market is going to go turn back, I'm going to earn more, I would rather say, hey, what if market continues to go higher? I would rather collect more premium and reduce my risk. Okay. The interesting stuff is short iron fly or or a strangle or a straddle, which is your calls and the puts are on the same strike price. And the moment you put your trade, one of them is challenged. Okay. And the mechanics doesn't change. I think the mechanics is still the same. So if you've sold this, you would have collected $4 to $5. It's at least not in the recent one, because the VIX is now below 14. But when the VIX was around between 16 to 20, it was easy to collect almost $5 at a $10 white iron fly. I had a few trades on ETFs with the same, but now I was trying for it for July expiration. I was like only $3.60, 70 cents. I'm like, okay, I'm not taking that right now because the VIX is so low. But anyway, coming back to this, if you're done this, you collected, let's say on an average $4. Stock either goes down or moves up, again, depending on how soon you should react to it, separate logic around it. But when you're trying to adjust it, if it's challenging your call side, move the put over, right? Maybe move the put over by $1 or $2. So don't go below more than $4, because then we are locking in the losses. Even if the stock comes back, if you have gone or moved your put by more than $4 or more than the premium collected, you're basically locking the loss. But we can move it $2. If a stock comes back, I still exit the trade by making $2. So at overall, I would say the theme perspective is still the same. Try to collect more and more premium so that you reduce the risk in the trade. In case stock comes back, you end up making more than what you were initially. If a stock continues to challenge you, we lose less because I've reduced the risk in the trade, right? Essentially, that's in nutshell is all around adjustments. Of course, we have to take care of how soon to start adjusting. I don't want to end up in a position where you have a straddle and the stock moved of $1 and then you say, oh gosh, I need to adjust it now, right? When you have to adjust, how much you have to adjust, and what kind of adjustment do you want to do? Do you want to add a put if a call is adjusted, or do you want to roll it to the next month, right? So time-based roll, strike price roll, or adding a different leg. These are the decisions that we have to take. And with the time, I think everyone comes up with their own way of management because they figure out what works for them as an individual, how much time you may have, and then you determine and say, hey, I think for me, this particular methodology works. But any method we want to pick, everything will be centered around get more premium, reduce the risk in the trade, reduce the risk, reduce your cost basis, reduce the risk in the trade. That's at a high level. Steve saying selling 30 delta puts is risky, the probability of touch. Yeah, the probability of touch will be 60%, but that's a probability of touch. not really the probability of being in the money, right? So probability of being ITM is still 30, but depends on, how much you love the stock. So some stock where I no way want to take any risk, I'll probably go and sell 15 delta. Some stock, if I own 200, 300, 400s of the share, maybe I'll do one contract at 30 delta, right? In some cases, I might. So it depends on it. But I think you guys, each individual will figure out what's the best delta for them would be. Generally, yeah, between 30 to 20 delta is where I can find some decent premium, which is worth for me to make the trade. Sell 15 delta, put spread is almost always profitable. Going out to 15 delta at a short put and then buying another long leg to create a spread, the amount of a premium that we get will be very less. I don't know what your experience is. My experience is going out to 15 delta and then converting into a spread. You don't get paid really well enough for the amount of risk that we are taking, right? It will almost always works out, but the one time that it may not work out probably could take away all the gains. To me, that sounds more like picking pennies in front of a steamroller, right? The proverbial, what do you say? The term that they used to describe why option is risky is there a risk worth for me to collect that additional, to collect that premium, just in case if, it happens to be that sequence that when I put a trade, stock actually blew through that put spread. I have not find at 15 delta, doing a put spread with a short strike at 15 delta. If I do a put spread, I think generally where I find some decent premium is maybe short put at anywhere between 20 to 30 delta, and then go out and buy a long put, further down. Then at least I find some decent premium worth for me to spend time and, worth the risk that I'm taking. Dave says, I usually look through the option chain, multiple expiration, see where the high volume is. If there are high volumes, open interest, same strike, 3-4 expirations, I'll follow. So Vivek, you said you only sell monthly covered calls. So what delta are you selling? Yeah, so I think I already covered it. It's anywhere between 30 to 20 delta. In some cases where, let's say I have only 100 shares, or I have, let's say, 60 shares, then I have to be a little more cautious. I'll go and sell 15 delta. Okay. But otherwise, it's generally between 30, 20 delta is my sweet spot for selling covered call. There is not a way to not work out because it's a spread and the width is $5 to $10. Yeah, width is $5 to $10, but how much you get paid for it? You're going out at a 15 delta doing a short put, you're taking a short strike, then you go out $10 out. Do you take your long put? How much you get paid for it? I don't think again, it depends on what the IV is, but generally I have not seen the put spread so far away paying worth for a $10 white spread. Am I getting paid, let's say, $2 for it, $3 for it? Probably not. So might get paid 50 cents or $1, but that is 1 to 10 risk reward ratio. Is that attractive? Maybe not. Again, it depends on, as an individual risk appetite and how much you're watching or how much you can adjust. I generally won't take that unless I am doing the trade to acquire the stock, right? And I don't mind, hey, it's gonna fall down, it's okay, I'm gonna pick the stock anyway. But again, that's me. It might work for you, and it's great if that's working for you. So any other questions on adjustments? We're getting deep into options. This is what they, I guess this is what they, I'm not even sure if they teach in MBA classes. They do talk about options. They do talk about your Black-Scholes formula, how is option pricing determined. But I don't think even MBA colleges talk about the practicality of how you actually use these things in your portfolio. Okay. That's all. Sometimes I feel some of these college courses are overrated. They just don't. They just don't talk about the practical aspects of it. All right, let's talk about assignment, because I recently had to think about early assignment. And I thought, okay, then I should also want to talk about during the weekend session. So everyone familiar with the term assignment? I guess so. If you're an option, if you're into options, you would know what does an assignment mean and an exercise mean. Now, the reason I'm talking about assignment is mostly we are selling options. So we are at a risk of assignment. Generally, depending on what deltas you pick up, etc., you may not get assigned, or we have a fairly good idea of, as an investor, I have a fairly good idea of if I'm doing this short call, short put, when is there a risk of assignment, right? It's generally pretty close to the expiration. But sometimes you get stumped because you thought, hey, I'm on a July expiration and I got assigned this share. So what happened? There's so much time left in it. And now suddenly I'm short of depending on if you had a short put, then you're a short of a cash, or if a short call, you don't have a stock, you got cash in, depending on whatever the trade is. But during my early days, these early assignments used to surprise. It used to be suddenly pop on and get an email, I've been assigned. I'm like, why? There is so much time left for expiration. How could I get assigned so soon? And it's not that every stock will be. Some stock will get assigned, some won't get assigned. So do want to talk about that. I think there was a comment earlier around assignment that I didn't read. So let me read through that. Yeah, early assignment usually to collect dividend if time premium is less. But what surprised me was 395 ADB was not exercised early. No. Yes. So the early assignments could happen. Let me see some interesting comments. Then we'll get into the early assignments. Steve, no MBA graduates work in an option pits. You need street smart high school drop-off to make money there. But now there are no option pits. Now there are only computers. No, there are no more pits anymore, I guess. I shouldn't say that as a generic blanket statement. I think there are still some very specific pits on some exotic instruments. But the whole idea or the picture of the stock market, people gather around a pit and shouting and showing the signs, no longer happens. Now the stock market is a bunch of computers sitting in the racks, I guess. Oh, by the way, I've never been on a floor pit, so I may be saying everything wrong. But nowadays, everything is computerized. But the reason is, I mean, I've spoken to a few friend of a friend who did MBA from Warden, I think a few years ago. And he and I sat together. He wanted to understand how these things are. I'm like, yeah, I know how the Black-Scholes, I read about it. I read about the pricing and all that, but I really don't know how do I use it. I'm like, okay. I'm like, I didn't read in school, but you learn when you actually do the stuff. I used to have a Wall Street analyst in my day trading group. He was just starting out. Of course, he tried to be anonymous or he gets in trouble. Yeah. All right. So let's talk about assignment. at least what I've seen, there are two cases where you could be risk of early assignment. Right? One is, of course, if the extrinsic value, or what you call as time premium in the trade is very less, right? And this very less is little subjective, because depending on just the ticker, it could change. Right? Is 2 cents less? Is 5 cents less? If it is a Tesla wherein I can get a premium of $10, maybe 5 cents is less. Okay. So sometimes I've seen I could get assigned when the extrinsic value has really dropped down. Means yours, or put it the other way around, your stock has gone, your position has gone way deep in the money. Right? It has gone in the money doesn't mean it's going to get immediately assigned. I think that's one challenge which a new option sellers have is, gosh, let's say I sold this Oracle. Say I was in Oracle at a covered call, and when the prior to result announcement, Oracle was 107, 106, 107. And say I had sold 110 call at that point of a time, prior to earnings, right, at 110. And it was a July expiration call. After the earnings, now the stock is up to whatever, 125. Am I going to lose my shares in Oracle? Probably not, because there is 51 cents of extrinsic value still remaining in this. Right? So, and right now it is, so you may not lose it immediately. Right? But if it starts to dwindle down to 4 cents, 5 cents, that time you might think of, hey, I may lose these shares soon. And then you can decide whether you want, what action you want to take. So one thing is watch on the extrinsic value. Thinkorswim can show you the extrinsic value right in the option chain, right? And as you would notice, the deeper in the money it goes, the extrinsic value continues to decline. So that is one stuff. The other thing is, let's say you have 71 cents of extrinsic value left in it, which is a decent amount, but you still could be at an early risk of assignment. And that is a case which I had to go through, not that it was assigned, but I had to take an action to avoid that assignment on Friday. So as I've told you guys, I've been holding a lot of negative deltas on QQQ. So I have a short call on QQQ expiry, not on this, it's on taste to work, so you won't see it here. I had a 30, oh, I'm not in QQQ here. So I have here I have only two. I had on 30th June, I had 295 short call. Right. I had a 300 strike price short call. I think these were the 2 months which I had to take an action. So and I've been holding this for a few months, which has been wonderful. Overall portfolio is doing great. Of course, the calls are not, but that doesn't matter. And I'm like, it's 30th June. And then I realized that QQQ is going to pay a dividend. I think on Monday, it goes ex-dividend. Then I realized, oh, if it is ex-dividend, then someone who's holding a long call, the opposite side of me, and that's what generally the other thing when you get into early assignment is there's an upcoming dividend. So if there's an upcoming dividend, the other party, the party on the other side could call the shares, could exercise the shares. And if I'm a short call, I could get assigned to deliver the shares to them. right? So, and then I'll end up into a short share in my position. I'll get the cash into mine. So I'm like, oh, I need to do something, because come 20th, it's going to be X div. So the way, it's not that always if there is a dividend, you'll be at a risk of assignment. I also hold a short call at 330 for the same expiration, not 330, it was 345 or something, for the same expiration period, right? So if I look at 345, my extrinsic value is 82 cents. 295, 300, extrinsic value is 24 cents, 25 cents. Now, the way to figure out if you have a risk of early assignment, even though there are 13 days left in the trade, is what you do is go to QQQ dividend announcement. It already shows up in my history. This is what I had to do. I'm like, okay, how much is the dividend does QQQ generally pays? I was like, okay, last we paid was 47 cents, right? Maybe I'm assuming they're going to pay 47 to 50 cents. Then it means anywhere where the extrinsic value is less than the amount of a dividend is at a huge risk of early assignment. So I had to take care of those shares. Means I had to close that position and then open up equivalent delta positions at a higher strike price, which has got a more extrinsic value. Okay. So 295, I had to close it. And I think I opened maybe 350 or something. I don't even recall. 300, I had to close it because both were like 25 cents. I still retained 345 because, hey, the premium out there, I mean, the extrinsic value is around 80 cents. QQQ has never paid 80 cents. I'm like, that is pretty safe. Not going to be troubled by that. But if there's an upcoming dividend and you are holding whether it's a stock or it's an ETF, but if there is a dividend coming up, you need to do is watch how much is the time premium left in your trade. If the time premium left in the trade is less than the amount of dividend, then it's a, I shouldn't say almost 100%, but it's a 99% chance that you will be assigned early. Doesn't matter. I've been assigned early 45 days before expiration sometimes, because I missed out that there was a huge dividend, some special dividend that they announced, and I missed that out. And that dividend was way more than the amount of a extrinsic value or the time value left in my covered call. So that's how you make a decision. Go and look at what's the extrinsic value, time value left in your option trade. If it is more than dividend, then you generally are not at a risk. But if it has less than dividend, then you could be at a risk. Yeah, that's how you make a decision. All right. A short call on QQQ. So no SQQQ shares, no SQQQ shares. Buying a SQQQ shares means I have to deploy more capital. Right. So that's a problem. If I short QQQ, I in fact get cash available to me rather than me deploying cash. Steve, I have to go. All right. Okay. So I think Steve already left. Vivek, these are naked short calls on QQQ, covered calls. These are all naked calls. I mean, the reason is because I hold, you look at my portfolio, top 10, you see Google there, Microsoft there, Amazon there, ASML there, and then QQQ itself is there. So I hold some QQQ, but most of them are naked calls, short calls on QQQ, just to reduce the overall delta in my portfolio. Right? So let's go back to our portfolio hedging sessions. It's just from a portfolio management perspective, right? This is, I use SPY and QQQ all the trades in SPY QQQ, SPX, NDX are focused on overall portfolio level and not at individual stock level. Covered calls I do, which is at an individual stock level. But these indices or these big ETFs, market ETFs, I just use it to reduce the risk at a portfolio level. They say I do have a ES 1400 call for December option. Oh, that's too far. I don't go that far away, and I've never done futures. This is ES mini. Yeah, I've not yet dipped my, I would say, feed in future. I know I don't say it anymore, but I think in 2020 I told I want to make it as my 2021 goal to do futures. Didn't do it. 2021 I said same thing. Maybe in 2022 I will dip into futures. I didn't do it. Now I don't even say it. I mean, I don't see the need. Not too much margin. I know in futures you can get span margin, but even I'm on a portfolio margin anyway. So I think not too much a difference from margin perspective. Just that I have to learn few other things and on the futures and the different exploration cycles and all that stuff. And I can kind of get the similar delta, reducing deltas using indices, NDX or SPX. Yeah, so 2022 is when I started doing a lot more indices. Prior to that, I was only doing ETFs. I haven't really felt that I'm missing much or I don't have some things in my wheelhouse because I'm not doing future. You're looking at delta neutral. No, I'm still delta positive, but the idea is I think I'm always going to stay positive because I'm optimist. But the idea is, hey, you can shave off some of the deltas, right? So that's all. I'm not delta negative right now. But yes, I continue to look at where the market has gone and continue to reduce the deltas to keep it at a level which I feel comfortable. Net is still positive delta. Cost is known for special dividend distribution, Costco. Futures most used to day trade. Yeah, I mean, I can't. Day trade just doesn't work with my work. Cool. I read another article which was very interesting. I don't think I have it for today. Maybe I'll bring it up in the next meeting. Sometimes some of the games that CEOs play to punish short sellers, special dividend, special type of dividend is also one such game. We'll talk about it a little later. But that was an interesting read for me. If that's not what the CEO should be focused on. CEO should be focused on not punishing the short sellers, but not punishing the short sellers by doing this gimmicky stuff, but by increasing the business and the value of the company. But sometimes CEO do resort to it. So I'll find that I'll probably bring it up for discussion. That was an interesting read. Okay, what else? I think, we are already 10 minutes over. Anything else we want to talk about? Other thing that caught was someone knew something because just before regulators went behind Coinbase, someone had bought 4,800 contracts of Coinbase 50 puts. So that means investing $86,500 and printing 2.6 million. I would suggest you do that unless you know someone in SEC. These are always very low probability trades. Friday I had some interesting trades. It was really mistake on my part. Turned out to be great. Bought ES long call pre-market. Option expired when the market opens. Immediately cash settled into my account. Yeah, ES. I think this. Oh, ES also settles at the market opening. I know some of these. And this is learning for me. Also, like since 2022, I also forget about these things. This NDX and SPX, they all settle at the morning opening. And it means if I were to take care of position, I need to take care of it on Thursday, whereas every other ETFs, etc., they all expire on Friday. But I generally have a spread, so, and those are cash settled, so not much of a not big deal. But I do have to watch out. Hey, this stuff is expiring on morning open. If it is within the spreads, that is where I have to take a decision. If it is fully in the money, in case of both SPX and NDX, these call spreads were fully in the money because the market has gone up so high that I'm like, yeah, it will just cross out each other and it will be cash settled. So what are you looking to hold now? Non-tech? No, I still hold tech in my portfolio. I put stuff in my coffee can. Again, a short term, yeah, Google could go down, probably. Nvidia could go down, probably, but I will still hold those stocks. Google, I have a collar on Google. On Nvidia, I have a collar. Collar spread, I would say, because the craziness can continue. Who knows? When the craziness will end. So I have a call spread and a long put sponsored by the call spread on Nvidia. I have plain collar on Google, 140 short call, 110 long put on some of my holdings of Google. What else? I have a negative deltas on QQQ. So every day when I see QQQ go up, one of my portfolio will go down because that's holding negative deltas. But that's fine because the other portfolios go way higher than that. What else? Amazon continue to sell covered calls. Microsoft, I have a collar spread just like Nvidia. ASML, I had a call spread which I had to close, sold some shares. I now have an iron condor for July. It goes back down, I'll buy the shares. If it continues to go higher, fine, sell some more and close the call spread. But yeah, I have a short call spreads on NDX. I think a couple of them. Short call spread on SPX, short call, naked call on SPY, QQQs. So yeah, so stocks I'm holding and ETFs and the indices I'm using to reduce the delta. Overall, still positive delta. Non-tech side, non-tech side, which one? Let's say, what do you consider non? Nowadays, every company is a tech company. Energy, I hold ETFs, mostly energy, healthcare, industrial, where I haven't picked up any individual companies for analysis. I'll mostly have ETFs. I hold Boeing in my portfolio. I have a healthcare. I have J&J for some time. I continue to hold that. The healthcare, I have XLV. What else on healthcare? I think these two, J&J, XLV. I have a Berkshire. I have a Markel Insurance, which is like a kind of a mini Berkshire. Natural gas, nope. I just don't understand how natural gas works. To be very frank, natural gas is like so volatile, and like I'm not a day trader. I don't know how to work with natural gas, but I use XLE. I hold AMLP for oil and whatever oil/energy play. I think those are the two ones that I hold. What else? Yeah, show me. Let me just bring and see what I hold. No nat gas. Cool. There we go. Okay. Yeah, then I have XLI, industrial, Disney, some silver, SLV, gold, GLD. I think gold is in top 10. Utilities, I don't know. I used to have XLU, but 2023, I don't think I traded in XLU. And I don't hold XLU in my portfolio. I have TLT, which is non-tech. What else is non-tech? GBTC, if we consider non-tech. Verizon, because Verizon is a good dividend payer, is a non-tech. Disney, GM, Ford. GBTC Bitcoin, yes. Yeah, I guess. And of course, cash position. Interest guy, always something interesting stuff for long term. Let's see what he says tomorrow. Isn't Bitcoin dead? I don't know. I don't know when you joined, but BlackRock just filed application for Bitcoin ETF. I don't know. If BlackRock is seeing something. They may be seeing something why they are filing it.
Oh, Vivek, can you talk about the feasibility of these Bitcoin ETFs? Like,
so Bitcoin ETF, SEC has rejected so far all the applications that have been filed for Bitcoin ETF.
Oh, excuse me, there is one. Hold on, let me check my hold on. There is one because hold on.
In US, there is none which have been approved. There is in Canada, yes. In Brazil, yes. Not in US. That I'm pretty sure. Then there is a GBTC lawsuit going on with SEC to convert their trust into an ETF. So
Okay.
that lawsuit is in the court. There are Fidelity had also applied for ETF. Their application got rejected. Valkyrie applied, got rejected. ARKK had applied. I think the decision is still pending. So either the decision is pending or it has been rejected. There is none approved in US. Friday, BlackRock also applied for Bitcoin ETF. So BlackRock is the largest asset manager in the world. So
thank you for answering what I was trying to look up. No, look up the resources. Thank you. You already answered it. Thank you.
no worries.
You are brilliant.
No, I'm not. I'm just trying to read.
No, you're brilliant.
The information is available everywhere. Just we need to put in effort. Caterpillar, DE, DPZ, LLY, BMY, NVO. Yeah, Caterpillar is all my excellent. I just don't understand. I'm going to have to spend time in understanding the industry, which I don't. So I think I have to, I'm right now not keen to add more tickers. So I'm holding of whatever I have. And we'll see. But ETFs are there. So I'm like, hey, if I want exposure outside of these individual companies in a sector that I don't understand too much about, let's pick an ETF. But that's my go-to case. Like I said, if I want to pick an individual company, I really want to understand how the business works, how the cycles work, how the company plans and all that stuff are. Maybe once I'm done with, I don't have any other responsibility, no job, probably I'll start picking up these other industries also. So I can spend some more time in learning about it. Uber is back in the news. Was there a news? I didn't. I mean, Uber is back on my portfolio for quite some time. I've been bullish on Uber for a few years. The stock hasn't done that great, but the business was still performing. So I don't know what happened to Uber. Uber, if you're Uber investor or want to be an investor, you should listen to the podcast. I think I actually tweeted about it. There's a podcast called Acquired Podcast. Go and listen to their recent episode where they interviewed Dara Khosrowshahi, the CEO of this one. It give a good insight into Dara as a person and what his thesis is about Uber, where he wants to take Uber. So anyway, I'm a shareholder, and so it was a good one. Nice info. If you are a shareholder, or if you want to be a shareholder, if you want to know about Uber, this was a good refresher for me. But I don't know what's the news on Uber. The stock has gone up, but I didn't realize what's.
They're just talking about it that they have the robo driving and all that stuff. It's because I think they kicked Lyft's butt last week for some reason.
Yeah, no, Lyft. So I don't think whether they kicked the Lyft. I mean, the Lyft has its own problem because, like, guys, go back to 2 years, 3 years when I think, where was it when I did the whole Uber deep, the deep dive into Uber. Just like a 10-pager. I went through the whole document of deep dive into Uber. The reason why I got bullish on Uber was because they expanded into other businesses, right? They had freight business, they have a eats business, they moved to logistics. Then they also started to monetize their real estate on the phone and all that. And they are into multiple countries. Lyft is only in moving people and only in one country. So this is a very competitive business, very difficult to make money unless you have multiple revenue streams. And Lyft got hammered during COVID because they didn't have Uber, they didn't have equivalent of Uber Eats. So Lyft has its huge problems, and now more and more drivers are actually shifting towards Uber. So Lyft have to either discount themselves to death to retain those drivers. And I think that's one competitor going out is probably giving a lot of a chance to Uber, right? So from that perspective, so I think my thesis of Uber was not just the Uber that we used to take to go places, but a lot of other businesses, and also how they can monetize, the lot of data, etc., that they have. So for good, I mean, it is yet to play. Uber is still lower than its IPO price, right? But for me, I didn't buy it an IPO. Let me look at but I've been selling options on it, reducing the cost basis while Uber does the stuff that it will do. And that's all we can do. Yeah, so my cost of acquisition was $41, and I'm looking at it. And over the years, I sold premium. My current cost basis is $28. Right? They're selling options. That's what it helps, right? So whether Uber has come back to $41, I guess. So Uber has just broken even, but I am like kind of up already 30% on my cost basis. Yeah, but I'll hold. I mean, I still have I think a covered call and a put spread on Uber. Probably covered call is not in the money. We'll deal with it. Cool. Alrighty. All right, guys. Thank you. Thanks for joining in today. Long weekend. So go out, do some nice stuff. The weather is nice. We'll see what the kids are planned for tomorrow. Good weather to go to the beach as well. I don't know what we're going to do. But Monday, markets are closed. So don't be shocked if the prices are not changing on your platform. Market is closed. I guess Futures market may be working, but the stock market is closed. Bye-bye. Talk to you week after, talk to you next week. Okay, so 4th of July, there will not be any session. That's a long week for us. We have an off on 3rd of July also. So I'm sure we will have some plans. Even if it is at a home, we're going to have some staycation, maybe go around local places. We got 4 days of holidays. So no session of 4th of July. I'll cancel that. Barbecue, maybe, yeah. Some veggie barbecues. All right, guys, let's go.